As you guys know, we've been covering Fastenal for quite some time now.
And it's boring. Probably the most boring stock you could think of. It's screws and bolts and washers and nuts and things that fasten other things together. Well, anyway, it's not exciting stuff. And before we get into it, I just want to let you know that Tom wrote this script. So whatever I say is all his fault. And if you find it boring, it's him.
Hey, it gets better. It's like my dad jokes. They get better over time. Anyways, Fastenal came out with their third quarter earnings report and the stock jumped about 10% in one day. For a stock like Fastenal, it just doesn't happen.
Here, look at this chart. Jumps like these are common in risky equities, but are not typical for Dow-based companies like Fastenal.
The interesting thing about this is that their earnings report, as far as we could see, didn't really show anything in particular that would warrant such a jump like this.
Not at least until you zoom out and look at all the overall economy. Taking a look at what's happening overall with the economy helps us understand what actually happened with Mr. Market.
Professionals in the industry have coined the term smart money and dumb money. What this basically means and how it relates is that the smart money represents the professional institutions managing 401ks, ETFs.
That's 100% us.
Yeah. And the dumb money represents what's also known as the retail investor, people who just hop into their brokerage and do whatever it is that they do.
Which we here at TDD coin as Tom's stock picks without my glorious and always impeccable investment advice. You got a weird sense of humor, man.
It was good. They're supposed to entertain. It's finance people. You're supposed to. Are you not entertained?
What we've been seeing is major institutions pulling money from risky investments like the Magnificent Seven and putting money en masse into assets better prepared for an impending storm. Our partners at Seeking Alpha have been flooded with articles discussing major companies laying off people in droves and investment firms pulling profits from stocks that would otherwise be considered risky in an economic downturn.
Now, if you want access to that information, we have a link with a discount down below. Also, if you're finding that what we are talking about is useful for your financial journey, please subscribe and like so you can get more of my beautiful face in the future.
Your beautiful face, huh?
Yeah, my beautiful face. Moving along, we can reinforce this opinion by looking at what the earnings report directly shows, and this time, we're going to have Brian do all the fancy numbers.
Why?
Because it's your turn.
Since when does it work that way? You do all the boring number stuff. I do all the exciting and happy and fun and humorous stuff.
So I get to be Mr. Boring?
Exactly. If the shoe fits.
Fine, I think. Looking at their latest report, we pulled a few things that we feel you would be interested in to reinforce that clickbaity title we pulled everyone in with.
All 10 of you. Thank you for watching, all 10 of you.
Hi, Mom.
First, on page 2, we can see the daily sales growth rate declining to about 1.9% for Q3 of this year compared to the beginning of the chart. Now, this isn't that surprising considering the fact that COVID created a huge deficit in orders for a short period that was then followed by a burst after things opened back up. If we look at past presentations, we can see that bubble more clearly. Net income per share shows a positive increase from 50 cents per share to 52 cents per share. Woohoo! That's the nice, predictable pace that we expect from them.
Thanks, Tom.
I can't believe you. Did you make me do the thing? You made me say the thing. I wasn't good.
On page 3, we can see these positive trends continuing. Their active locations are growing as well as sales through e-commerce, which were up an impressive 33.2%. On pages 6 and 7, the operating income margins are down slightly, but nothing out of the ordinary. The cost of IT were noted for 2025 as part of the reasoning for their increased or decreased margins.
And that's why working in IT sucks, folks.
Truth. Skipping down to page 11, we can see their full-time equivalent staffing dropping by 355 employees as discussed in the call. We found this interesting as far as numbers go, that they are increasing their sales and locations with less people.
Because that always turns out great.
Do more with less. They also continue to push their goal of getting more large-scale customers to supplement their small business base. The chart for their progress on this can be found on page 13. What this means, if we take everything into account outside of their e-commerce and digital footprint growth, is there really isn't anything here directly correlating to such a huge jump in price. At least this is why we feel the smart money is moving funds in preparation for some market volatility.
Or the zombie apocalypse. We haven't talked about the zombie apocalypse in a while.
You're right. Or it could be the election. I mean, basically, you get the idea. We personally hold shares in Fastenal, so we like to keep a close tab on their business to see how they're doing financially as we share in their profits. We like to know the businesses we are investing in are doing well. And if it was your money, I'm sure you would too.
And hey, if we missed something in this report, please let us know. And if there's a report out there that we didn't see that explains the 10% jump in stock price, put it in the comments and we'll give you kudos.
You just invited the entire Reddit crowd to troll us.
Troll us. I want to see 1,000 comments in there. 1,000.
It's trying to make me lose sleep.
Get us to 10,000 subscribers. As always, thank you for watching and we hope to see you in the next video. That's all we got. Go away now.
What? Where are you going?
We're done.